It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome to the Jill on Money show. I am so delighted that you have joined us. You know, I just printed out new scripts and I just dropped coffee on everything. So annoyed. No, I'm not annoyed with you. I'm annoyed with me. Oh. Anyway, happy graduation season. So it's like every weekend everybody's going nutty. I know, it's tough. That said, I am delighted to wish all of you graduates a happy job hunting. Good year for finding jobs, actually, for you graduates of college. Not so great for high school. Mark, what was the worst high school summer job you had? You were always working in a restaurant? That's a hard job. I mean, it's a good job because you make money, but it's a hard job, I think. So you're a better person than I. I mean, my best job, obviously, was that I worked on the floor of the American Stock Exchange for my father in the back of the trading booth. So that was the most fun. The worst may have been when I was working in my mother's real estate office. Oh, I just never, ever could make any of those realtors happy. They were a very demanding bunch. That said, it was good training for what I didn't want to do, which is go into real estate or frankly, go into any job where you had to be in an office or running around all weekend long. One thing to work on the weekends because you really need to or choose to. It's another thing when you feel like I have to work because this is where the business is on the weekends. That's not so great. Anyway, this is the program that takes the mystery out of your financial life. And if you have a financial question, shoot us an email. Ask Jill at jillonmoney.com and tell us what your best and worst summer job was. That's a good question. Best and worst summer job. What part of the house? By the way, Mark, were you a server or were you a cook or were you a busboy? What were you? Busboy? Yuck. People are gross, huh? Oh, the bread station, a little bit cleaner there. Yeah, he didn't, and he's got all of his digits. So it's very well done, Mark. All right, let's take a call. Leith is on the line. Hello, Leith. Welcome to Jill on Money. Where are you calling from?
Hey, Jill, good morning. I'm calling from Wilmington, North Carolina.
What's going on in NC?
You know, it's a great state, but
Yeah.
This past couple of days we've had some really horrible rain.
Yeah.
So
Bad news.
The weekend has really been kind of, washed out.
It's a bummer. Well, and here we are starting. I'm talking to you right before you get ready for yet another short week, which I hope is filled for the summer is filled with short weeks for you. So this will be very good. What can I do for you?
So, listen, recently retired, gave my wife and I an opportunity to take a look at our savings and our IRAs and our 401s and everything and combine them and more or less have a better view of what we have now in terms of our retirement savings.
Okay.
So my question to you is, our savings are made up of IRAs, 401s, some cash, some real estate and that type of thing, but I'm not an expert in finance, so my concern is how do I know or what are some flashpoints that I should be aware of to say, hey, wait a minute, are we in good shape in case we have another economic downturn? I just want to be prepared and not caught off, not knowing what to do when I start to see the warning signs.
I think that's a great question. Let me go back first and do the more mundane stuff, which is you and your life. So you are retired. How old are you?
I am 67.
And your wife is how old?
She is 66.
And is she also retired?
Yes.
Okay. If you look at your total income from Social Security, pensions, any real estate income, what is the income that that is coming in every year now?
Well, of course, that depends, but probably somewhere around 100,000, maybe.
Great. And does that 100 grand cover your basic needs or even your desired needs?
It does.
Okay, so you're good. So the income you're generating is good. Are you in that $100,000? Are you including money that's coming out of your investment accounts or just money from pensions, Social Security, or real estate income?
It would be really a combination of all.
Okay. So if I had to say, what is the income that is coming almost automatically? So Social Security and pensions, what would that number be?
That would probably be 75% of it.
Oh, okay. So great. So Social Security and pension. And so you need another 25 grand from your total savings / retirement savings to generate the money you need on an ongoing basis, right?
I would say that's a fair statement.
Great. Now, tell me how much money right now you have in just retirement assets, meaning your IRAs and your 401ks.
I would say probably close to $2 million.
Okay. And savings, cash, meaning money that's already been taxed that's set aside.
Yeah, probably another one.
Okay. And real estate, you own your home now?
Yes, I do.
Okay. No mortgage?
No mortgage.
Great. Let me just say this. If I could give you like one of those weird checklists and from like a doctor, and I would say, if you gave me this as a doctor, I would say you are in stunning health. You have nothing to worry about. Okay?
Well, yeah.
You don't want? You want to worry? I'll let you worry. Don't worry.
No, I don't want to worry, but I want to be smart. I don't want to be caught not knowing something.
I got you. But here's one of the reasons why we go through this sort of exercise, because you got $3 million, right? Mm-hmm. If you were the most risk-averse person in the world, if you said, I hate risk, I never want to, I could just have maybe 20% in the stock market. That's it. And everything else, I really want to batten down the hatches. I want to be safe. You would still be able to pull $50,000, $60,000 out of this account every year, pay some taxes due on the pre-tax stuff, and have the money you need to support yourself. The reason why that's important to know is you're going to ask me a question now about how to prepare for bad things happening. And what I can tell you is the easiest thing to do to prepare for bad things happening is to save a boatload of money. And you've done that already. So that is essentially the hardest work. And it's the biggest challenge that when people call in here, I have to say to them, well, you know what? You actually haven't done such a good job. You have done an amazing job. So the reason why this is so important is that you've put away the money that you need, more than you need. The money that you need to generate income-wise is really such a low number relative to the total assets that you've saved that you don't really even have to take on a lot of risk. So what does that leave you with? That leaves you with, we're going to a break. I'm coming right back to you. When we come back with Leith, we're going to talk about how you can prepare for the next economic downturn. And we're going to talk about the very tried and true methods that you don't have to be a market timer to execute. So stay tuned. You're listening to Jill on Money. When we return, more of our conversation with Leith and preparing for the next economic downturn. It's Jill on Money. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back with Jill on Money. This is the program that takes the mystery out of your financial life. And before we went to the break, we were talking to Leith, who may get the gold star of this show as the most prepared retirement saver. So do you feel a little better about that, Leith?
I do, but let me ask you a question before you get to the downturn thing.
Yep.
You know, I listen to a lot of different people about finances and read things, and one of the things I'm hearing is somebody saying, don't have a lot of cash in banks right now, have it in the market.
Yeah. Because
the market is, going to take off and
right.
50,000 and all this kind of stuff.
Right.
So the question is, you have cash in banks in these, not making any money. What should you do with your cash that you have in savings accounts in banks. That really is not doing anything.
So first of all, I think that people who are saying, oh, don't have cash on hand are idiots. Is that a nice way of saying it? I'm sorry, that's not, because you've got to have enough cash on hand to weather a downturn. So this gets into your question, which is, you've got cash on hand. What should you do with it? Well, one way to weather a downturn is to make sure that you've got some money in cash. So let's talk about what you would need to feel comfortable. Pretend it is, let's just say you retired and it's the end of 2007. You've entered 2008 with the exact same scenario you just laid out to me. And at the beginning of 2008, I will tell you that pretty much all these knuckleheads that worked at big investment houses were saying the same thing. They were saying, don't have cash on hand, the market's good, doing well, buy the dips, all those things, because no one really quite understood the magnitude of what was going to lie ahead of them. That said, the best defense against an economic downturn is to have basically no debt. And if, you had your mortgage still, it wouldn't be a big deal, but you don't have debt. And to have 2 years of expenses sitting in a safe place, which for you, you don't even, you get income. But let's say you said, I'm going to keep $200,000 in cash, and you want to maximize that cash. You want to have some laddered CDs. You want to have some short-term government bond funds just so you have a little bit of extra juice as opposed to a rotten money market or savings account rate, fine. But beyond that, you don't need more. And then when you really want to prepare for something going badly, you have a well-diversified portfolio. What you are now asking me is, well, how can I prepare for an economic downturn but also take advantage of the market continuing to rise? And the answer is you can't have it both ways. You know that because every investor knows that. So what is the portfolio that's going to prepare you for if something bad were to happen in the future, but also allow you to participate? And that is pretty much of a classic balanced portfolio. So if you looked at your retirement assets and you said, well, I've got half of the stuff that's mostly in risky assets and half of it in less risky assets like bonds, or at least having, it doesn't have to be the most boring bond, but it could be various bond types. That is sort of splitting the difference. But you can't have it both ways. And I don't think you need to. The part about your situation that's amazing to me is that, in essence, you don't actually need to grow your money. Your money will last you for the rest of your life. I know you don't want to give it away, but you have to ask yourself this question. Let me ask you, actually. I will ask you, what would make you more upset? If I looked at the next year and I said, let's say the next 3 years before you turn 70, in the next 3 years, you can either fully participate in the market's rise, or you would have to fully participate in the market falling apart. Which is more appealing to you?
Well, of course, if the market rises, right?
Oh, see, that's the fascinating thing. Maybe. Let's say that I said.
Well, but let me amend my answer to you.
Okay.
Well, my position has been always about pace and balance.
Right.
So I feel like our portfolio is balanced. I mean, we have domestic stocks, we have bonds, but we're very conservative.
Okay.
So I can be completely happy with not a lot of growth every year, but a moderate amount of growth, as long as it's, pretty consistent year in and year out.
Mm-hmm. But I guess what I'm wondering from my perspective is, well, what is it that why are you so focused on the growth part, since you are a balanced investor? You started the call with, how can I prepare for an economic downturn? And I would say to you,
right.
It's pretty easy. The way you prepare for it is to have some cash on hand and to make sure that you're not asking too much of your portfolio's performance on the downside. So if the market were down by 25% next year because we're in a recession, would you care that your $3 million turned into $2.5 million? Or would you be more concerned with making sure that that $3 million stays $3 million? In other words, as you get older and you need to rely on your assets to generate income, most people would say, I'm much more afraid of losing money than concerned about making money on the way up. And that's what I'm trying to figure out from you. Are you more concerned about losing something if the market were to turn south, or are you more concerned with not missing out on the way up?
I guess I'm more concerned with the first part.
Yeah, of course you are, because you're a human being, and that's the smart way to be. So what I need you to try to do, which is so hard, is I need you to try to drown out the little devil that's sitting on the side, sitting on your shoulder and saying to you, don't miss out on the top, don't miss out on this, because of course you're going to miss out on it. You are not the type of person who needs to actually capture so much of the upside. Frankly, if the market is up 10% this year and you're only up 4%, it doesn't matter. You're fine. You're in amazing shape. You have done the hard work. You've saved the money. So now, as opposed to every other knucklehead out there, like that really has to invest to beat inflation, and you don't have to worry. You are in a great place. So just try to remember that. Say, every time the market goes up, or the fact that I have too much money in cash, I call that, it's called sleep at night money. If you're really wanting to have a portfolio that is bulletproof against a downturn, that you've done it. The way to do it is actually to save your whole life and then not to risk too much as you get older.
Right. Well, no, I understand that 100%.
And I think you're in good shape.
I think, what I wanted to get from this call was a level of assurance and, I guess, confidence in what we're doing is the right thing.
Yes.
It sounds like we are.
Yeah, you are. And in terms of what you should be looking for in terms of a downturn, well, one good thing to think about is this. This market has gone up now, almost straight up. Well, let's see. June of 2009 is the bottom of was the beginning of the expansion. So the recession ended in June 2009. We're at the 9-year anniversary of the recession ending. The bull market has been going on more than 9 years. It is the second longest bull market on record. Does not mean that the market's going to crash tomorrow, but what it does mean is that we are more likely to drop in the next 18 months than continue to rise. So no one has repealed a business cycle. There is going to be another recession. It's probably going to happen in the next couple of years. There's going to be another bear market. Do you have a portfolio that can withstand it? Yes, you do. As long as you don't let that little devil on your shoulders start whispering into your ear, oh, buy Bitcoin. Oh, get into a riskier portfolio. Oh, cash is terrible. Who would have cash? All these things are natural tendencies. We are human beings. This is what we do to ourselves. You don't have to fall prey to it. You've done a tremendous job. You've saved the money you need. And so the big mistake that people make usually in retirement, they don't save enough or they spend too much early on. You're not making those mistakes. The portfolio part, the allocation, you got that down, man. You're in good shape. All right, that's it. Whew. Thank God, a good call about retirement. It's Jill on Money. And you know what? This is a show that talks about money, but we're not scary. We're not boring. We're having a little bit of fun. And we tell you some good stories, too. The phone number here is 855-411-JILL. Our email address is askjill@jillonmoney.com. We'll be right back.
Have a finance question? There are many ways to reach the show. You can call anytime at 855-411-JILL, send an email to askjill@jillonmoney.com, or tweet a question on Twitter using the handle @JillOnMoney. Just use the hashtag AskJill.
You're back with Jill on Money. This is the show where money is not scary or boring. It's just a thing. It's a little bit fun. It's a means to an end. You don't have to get all freaked out about it. We got your back, okay? That's good to know. I am Jill Schlesinger. Mark Talercio is running the program. And we'd love to hear from you. If you've got a question, just send us an email. Ask Jill at JillOnMoney.com. That's what Richard did. He writes that he has an irrevocable trust for his children. They are ages 32 and 30. Okay, irrevocable, guys. Here's a little quick note. Revocable means changeable. Irrevocable means not changeable. So you can draft a trust that you can change throughout your life. That's a revocable trust. An irrevocable trust, once you create it and fund it, can't be changed. There you go. Okay, so he's got the irrevocable trust. Kids are 32 and 30. It has 96% of it is in a total stock market fund, 4% in an international index fund. I realize they are still young. I'd like to get the assets more broadly diversified with their futures in mind. Is there a tax-efficient way to do the diversification? What type of an instrument should I look to get these funds? Would something like a 2050 target fund into which I gradually move funds be appropriate? Thank you. I think a couple of things. The trust, when an irrevocable trust is drafted, it has its own tax ID number. So when you diversify, it's just going to, the trust itself is going to pay taxes. So the first question is there new money going into this trust? Or is this trust has it already been fully funded? Because that might change the way that I would potentially think about managing it. At least in I guess for the time that you have this thing, it's hard to kind of plan for the future. But, look, long-term capital gains rate, I don't know what the trust capital gains rate is. I know the trust tax rates are. I'm guessing you're going to pay a lot on the trust. I think the top trust tax rate is something like 37% if you have like over $12,500. But be that as it may, I'm not sure it's really going to matter for you because if you want to diversify, you're going to have to pay the tax. So one thing is, if you're going to add new money to it, what I would simply do is instead of having a index, just a plain stock index fund, just add a bond index fund. And that could be a way that you diversify over time. I wouldn't use a target date fund. I think I would just use a stock index fund and a bond index fund and a total international index fund, and that's it. But you should know that there's going to be a tax liability for the trust. The trust will pay the taxes. All right? I hope that helps. Talk to an estate attorney, by the way. That's very important. Okay. Let's see. Here's a question from Kay. Here's Kay. I have a question regarding a fiduciary that I hired to manage my retirement funds. He told me the interest on my accounts would be 4 to 7% yearly, and it's been a year and only 10% of my money earned interest. It is in a fixed interest annuity. Dow Jones Real Estate 10, it's up under 5%. Okay, hold on a second. I'm not a financial person. I feel like I was lied. Let me get to the nut of this. I feel like I was lied to about these accounts. I had to consult with another financial planner just to figure out the information I just told you. My husband and I invested all of our retirement money, which is a hefty sum. We haven't spoken to this man to get out of the accounts yet. Thank you for your advice, Kay. Okay. If the person is a fiduciary, and if the person told you something that is essentially sold you something that is not in your best interest, then you may have to go back and actually say something to the guy or the boss of the guy. And I'm not sure if he's fiduciary because he's a certified financial planner or he's a fiduciary who was, let's say, an investment advisor registered with the SEC who gave you financial planning advice that was in your best interest, but not actual investment advice. So all that being said, here's what I would do. You already got that second opinion. I would be armed with that opinion, and I would probably write a very nicely worded letter to the guy to see, and I would copy his boss and see if there's an explanation. So I just want to make sure that you do that first before you start getting out of this and seeing if they have a way to remedy the what seems to be like maybe a big time miscommunication or an out and out bad faith sale of a product. We don't know which it is. Maybe you didn't understand it. I'm going to give someone I don't know. I'm trying to kind of be a good doobie in that. Anyway, give it a shot. That's what I would do. Don't go lawyer up yet. First, go back to the guy, find out the details, write a letter, maybe with that other advisor to help you out. Steve writes, I moved a whole number of shares from one account to another. The fractional shares stayed at Wells Fargo. Then Wells Fargo sold them but never told me. Can they do that? It wasn't a lot of money, but they said it cost $35 to sell the fractional shares. They also said the company wanted the fractional shares. Can they do that without asking? I bet that you've signed some sort of weird agreement that says that they can sell fractional shares at their discretion. Usually they're called odd lots. I wouldn't go nutty. I mean, I guess you could go through and see if you actually signed a customer agreement that said that. But a lot of miscommunication here, Mark, in this segment. You're listening to Jill on Money. We try not to miscommunicate. 855-411-JILL is our phone number. Our email address is askjill@jillonmoney.com. We'll be right back.
If you've missed any part of a show or want to check out a past show, go to jillonmoney.com for more great personal finance content.
You're back with Jill on Money, the award-winning Jill on Money show. I mean, how long can we get to talk about that, Mark? All year. Yeah, I think so. Mark and I won an award for the program. The show won an award. It's really Mark's award because he does so much of the work. I'm just a mouthpiece here. I just look nice and sound decent, I hope. Jill on Money, the 2018 Gracie Award winner for Best National Talk Show. National. That's you guys. This is all because of you. You have made this show fantastic, a great experience for me and Mark from the very beginning. When we both have other jobs. So we just do this because this is the most fun in the whole universe, this part of our job. And so this is such a great reward because it has just been so much fun. And, you listen to a lot of financial stuff, and what are they doing? They're selling stuff, right? They're selling. I did that. I had a radio show when I was a financial advisor. And, I was selling myself, right? I wanted people to call up and, sign up and all that. Some people have a radio show and they're selling other stuff for themselves. They're selling books. Although, Mark, who's going to be selling books later this year? That's right. I am going to be selling books. Just handed in my manuscript for my first book. Anyway, we'll be self-serving on that front also. But this award is for our performance in 2017. And again, thanks to all of you for making it happen because we don't get to do it without you. Hey, have you missed any of our past shows? You want to go look? Mark, are the 2017 shows online? Yeah, they are. JillOnMoney.com is our website. You can listen to past shows. You can listen to our podcast. You can read the stuff that we write. You can watch videos and television appearances. And you can sign up for our free newsletter. Mark, free newsletter. How we doing with it? It's growing, he says. He's just chewing his morning fruit as he said that. Trending up. My favorite. Okay, let's get to some of your questions. If you've got a question, just send us an email. It's very easy. Very easy. Send an email, askjill@jillonmoney.com. Okay, let's see. Here comes Colin, who asks, my question relates to whether to roll over or keep a 401k with a former employer. I know to consider expenses and investment options in the decision, but what I'm not sure about is if it matters that I've invested regularly over time, dollar cost averaging, but if rolling over to my new employer plan, you would sell those shares and buy into the new plan in one lump sum. Also, in the meantime, there could be a little market volatility. Does the lump sum cash out and repurchase in any way have a risk that you lose any power of your dollar of your dollar cost average gains? Does it work out mostly the same? I'm 31. I've got $100,000 in the 401k. I've got $58,000 in a Roth IRA. So when you roll over, there is what is called a tape-to-tape transfer. And presuming you're just doing a direct rollover, you're not going to receive a check for that $100,000. You're going to say, Institution A, send my $100,000 to Institution B, and then it's done. There is a potential couple of day process where you may see that you've missed 3 days of market movement. That's kind of where I would say you have to think about it, okay? But I wouldn't worry about that. So what I really wouldn't. You're 31. I mean, essentially, let's just pretend you had like you had $100,000, and for the 3 days that you were out of the market in your tape-to-tape transfer, the market rose by 10%, and your portfolio would have been up 8%, and you missed that. Over your lifetime, it's not going to matter. Make the best decision, not a market timing decision. Make the best decision for you, expenses and choices. So that's how I would do it. And it is one lump sum. And that is how I would handle it. Okay. So we got a couple of questions about this recently. It's funny. Here's another question about rollover. This is from Cheryl, who says, I have 4 small retirement accounts. I think they should be combined into one to maximize the earnings. Actually, you don't combine them to maximize the earnings. You combine them to maximize to minimize your management requirement, meaning that it's a pain in the neck to manage 4 different accounts. I have a matching 401k with my current employer. It has $4,000 in it. I just started in October. I have a Roth with Fidelity Investments, has $20,000. I have a deferred comp plan from a divorce. I have a small education retirement board account. I think I should roll over everything into either the Morgan Stanley 401k or the Fidelity Roth, but I'd like your advice on whether I could or should do that. Okay, quickly. If you roll this into a Roth, you've got to pay tax on everything. So ideally, what I think you should do is, first and foremost, I would probably roll everything into an IRA rollover at Fidelity and have all the money in an IRA rollover at Fidelity. Then what you need to figure out is, do you have the money to pay the taxes that would be due on the $60-something thousand? If you do, you can convert it into a Roth. If not, leave it as a Fidelity rollover IRA. Don't put it in the Morgan Stanley account. I'm sure you pay higher fees than you would at Fidelity. All right. Thank you for that question. A good one. You are listening to Jill on Money. Our phone number here is 855-411-JILL. Go to JillOnMoney.com. Go check us out and send us an email. Ask Jill at JillOnMoney.com. We'll be right back. You're back with Jill on Money. If you've got a financial question, tax question, real estate question, summer vacation question, let us know. I love vacations. Even if you do a staycation, I love it. I always wanted to do that, Mark. I always wanted to do like a great, I'm going to spend a week in New York as if I were a tourist. I never do that. Okay, Elizabeth writes, my son turned 24. I lost the head of household status, though he still maintains my residence while in college. I used to get several $1,000 refund. Now about $400. As a single mother school teacher, this was a hard loss heading towards summer break. I want to increase withholding, but I'm not sure what to do. I cannot owe taxes at the end of the year. I'm not sure what else I can itemize. Any advice is appreciated. Are you sure you're still going to have to itemize? That's a good question. You may not. So if you lose head of household status, the question I would have to you is maybe, when you look at the tax rates, you will be fine. Maybe the lower tax rates will actually be okay. So single is $12,000. I don't know what the head of household is. I should look this up, but we'll look it up. But I think that you might be. I mean, you say you're a school teacher, so I'm guessing that you're going to have a larger standard of deduction. You're going to have a larger standard deduction, and therefore you won't be an itemizer anyway, so it won't matter. So hopefully what I would do is this. Go to irs.gov, go to the withholding calculator, and see what your liability is. You may be actually in better shape than you think. So go do that. It's on our website it's on our website, Mark says. Is it under resources? Oh, Mark, I got to tell you something. You're just the best. The best. Okay. Anyway, if you're worried about your taxes for next year and you've just gotten your taxes for this year, there's a lot of different calculators you can play with. But do start with the IRS website, which is on our website, Jill on Money. Go do that right now during the break. Then you can prepare for next hour's excitement. It's Jill on Money. Our website is jillonmoney.com. And you can send us an email with your questions. Ask Jill at jillonmoney.com. We'll be right back.
It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome to Jill on Money. It's the first weekend in June. So, I know everyone always says Memorial Day is the unofficial kickoff to the summer. Not in the Northeast, it wasn't. It was freezing. Walking those dogs. I had to get a parka out, like a rain-proof parka. Anyway, it was a long weekend, so far be it for me to complain. I'll take a long weekend any day. Anyway, back to work for us. It's June, and there's a lot going on in the world of education. There's a lot of discussion about how the oversight of different types of regulators is changing. It starts with the student loan world, but it gets into bigger questions. You might think to yourself, well, who's got my back? I mean, the Consumer Financial Protection Bureau seems to be losing its teeth, and the SEC's got a new enforcement director who's not going to be quite as tough. So who's looking out for you? Well, it really will fall to the states. And now we know that the states are going to become more important. That's why we have invited Maria Vullo from New York. She's the superintendent of the New York State Department of Financial Services. It's called DFS. And she's going to tell us how the state-level regulators are trying to really make a difference. So here is our interview with Maria Vullo. So you made this big shift out of private practice, even though you were doing a lot of pro bono stuff, into public service. And tell people what the department actually does.
So DFS is an agency that was formed in 2011 by merging the former New York State Banking Department and the New York State Insurance Department and creating a financial services law that even gave it greater powers. So I regulate banks and insurance companies and other financial services providers in the state of New York.
How much power do you have at the state level when we know there's lots of regulators all over the nation?
Well, that is actually a critical point, particularly now when the federal government is not doing anything for consumers or real people. It's it's the job of the states, such as my agency, to fill that void, and we're doing that.
And it's amazing that you came in at this point, right? Because, I mean, obviously, if you were in a more activist environment at the national level, the state still has to do its job, and there are certainly cracks that things fall through. But now we have a new administration which is essentially rolling back regulations. We know that the Consumer Financial Protection Bureau has basically been defanged. So what can you do? Give us an example. Full disclosure, I know one of Maria's colleagues, and I heard all about this title insurance. So I got very excited when I heard. I may be the only person who got excited by title insurance. Talk a little bit about that example, how the state came in and what you're doing and what the situation was prior.
Sure. So title insurance, we regulate title insurance companies and the agents. And it's just a business where you have 95% of the premiums going to salaries and meals and entertainment and all this other stuff, and less than 5% on actual claims. Why? Because our record system is pretty good today in terms of transfer of houses and title. And so the title insurance industry doesn't really have a lot of claims. They certainly have to do some work. But I discovered and learned through an investigation that they were giving out gifts and gift cards and designer handbags.
Wait a minute,
and all of these things.
How did you find out about that?
We have very broad investigative powers.
So you get a tip?
Well, part of our investigation was some anonymous information, but I don't think that it was a secret that this is the way these companies and people were operating. And, you know, the agency has been doing for a very long time an investigation and looking at this. They are very aggressive in response, and I was not going to stand for it anymore.
It's amazing because it's one of those weird businesses where it's like, oh, everyone needs title insurance because you're closing on your house or your condo or your co-op, and you don't think twice about it. And so,
do you know anybody who ever made a claim against the title insurer because there was something wrong?
Don't think I do, as a matter of fact. So why do we have it?
Well, certainly years back, there's a need for title insurance because you want to make sure that your title is sound. So I understand the concept of it, but over time, there hasn't been much of a need. But your bank still requires it.
Right.
And so that's really why everybody gets it. And you don't really think twice because your lawyer or your broker, whoever brings you to the table, is like, oh, and they're the one that gets you the title insurance. So the consumer is never actually in the conversation of who should I select. And that's where the meals and entertainment and the lavish parties, because they're lavishing that on their referral sources. And then they're passing that along in rates. So you're paying more for your title insurance because they're having parties. And that's what I said, that's not appropriate.
Especially because I bet they weren't really good parties. They were probably really lame
I don't
parties.
go to any of those
Right?
parties. I
bet
can tell you that.
So explain how it's what we call a department or agency. Which one?
Agency.
Either. Okay,
yep.
so in your agency, how you coordinate with other regulators. For example, I'm going to throw out. Let's say that there's a bad actor whose bank charter is in New York, and there's an investigation that's going on through either the Federal Reserve or the SEC. How do you get involved in that?
If they have a bank charter in New York, we get involved because we have the charter and we have the authority to make whatever inquiry we think is appropriate of that institution. We learn about things from a lot of different sources. We can have information that's confidential provided to us. Our examiners in the agency who spend time in institutions learn things. We hear things from the outside. Sometimes we read about things in news reports, and we follow up on those things. There are many circumstances where we would coordinate. We coordinate with law enforcement. We have great relationships. I'm actually a law enforcement agency as well. I have prosecutorial investigative, not prosecution authority for criminal cases, but we refer out those types of things. We coordinate with other states. You mentioned the CFPB before. We had a terrific relationship with the CFPB and did a lot of work together.
Let me give you a particular thing that's just, consistently bugs me. So we have the Equifax data breach, right? explain to me what happens after like a data breach like that. You get hauled up to Capitol Hill, you testify. And then what happens, if, say, CFPB or the oversight, they have very weird oversight, actually.
They do.
So how would you get involved in something like that?
So we have gotten involved. So, that was just a horrendous data breach. 145 plus million Americans had their data breached by a hack. And it's a prime example of what happens when a company is not regulated. They didn't have good cybersecurity protections. They didn't have any good incident response. This is all based on public information. They didn't have anything, for a cybersecurity policy for a company whose entire product was acquiring consumer data and selling consumer data. Because I regulate the banks and insurance companies that also provide that data to these companies, I was seriously concerned about it. So we went out right away. We did a consumer alert. We did a regulation requiring them to register in New York and be subject to our cybersecurity rules. And we're working with other states to examine them on their cybersecurity practices.
We'll get back to our interview with Maria Vullo in just a minute. If you've got a financial question or you're worried about the regulatory body in your state, give us a holler. Our email address is askjill@jillonmoney.com. We'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
You're back with Jill on Money. If you've got a financial question, we'd love to hear from you. You can email us, askjill@jillonmoney.com. Go to the website, jillonmoney.com, and sign up for our free newsletter. Free! Yes, my ladies and gentlemen, free. Anyway, we curate some stuff. It's kind of cool. Right now, we are talking about regulation. And so often you guys will call the show and ask about specific insurance products. That can be a very thorny type of question to field because I get the reputation of hating insurance, which I don't. Instead, what I really think is most important about all of this is that we understand what these products are all about. And to help us kind of tear that apart and look at what these insurance companies are selling, we have to rely on regulators. Good news for you is that we have a regulator with us, Maria Vullo. More of our interview with the superintendent of the New York State Department of Financial Services right now. So let's talk about insurance companies for a second because I have a love-hate relationship with insurance.
Most people do.
Just going to say. So, certified financial planner. I love the concept of insurance. I think it is brilliant. I mean, you basically take this law of large numbers, you spread risk across a big, huge pool of people, and you get coverage. It's fantastic. Like, there's no other way. Like, I can't even, imagine a better concept, but the practices sometimes of these insurance companies can be mind-blowing. First, I want to understand, how is it that that this all sat at the state level, that we have insurance regulated at the state level, whereas securities and brokerage, they're state people, but really the oversight comes from nationally. Why is insurance so different?
It has been historically a state-based system since Benjamin Franklin in Philadelphia formed the first insurance company.
Oh, so
when there was a fire in Philadelphia, and that was the beginning of the concept of insurance, which, as you said, is a terrific and important concept. It's spreading the risk. The larger the pool of people who buy in, the ability to spread that risk and lower prices for all. So important, and it's been a state-based system from the very beginning. So there is a state commissioner of insurance in every state. I'm New York's, and we work through the National Association of Insurance Commissioners, and we actually have some pretty uniform regulations that we do together. But it's a state-based system, and it's important that it remain a state-based system because the states are connected to their consumers. And insurance is a consumer product fundamentally, and the states are also connected to their even their economic development on a local level and what's needed and what's not. But you have state governors, state legislatures that pass a lot of laws. And it's important, and certainly from New York's point of view, it's really important that that state-based system maintain, because we know how to protect our consumers best.
I hear that, especially on the health insurance, auto, property casualty. I totally get that. When it comes to life and life products, some of them are hybrid products that are also securities, like, the classic annuities, right?
Yes.
So how would you be involved if there was the sale of annuities that is maybe inappropriate for clients, and it's a variable annuity, meaning so it has a securities component? Is that all under the state umbrella, or do you get involved because it's SEC, because there's also these sub-accounts?
Right. So very, very important, because there are many circumstances where there is more than one regulator. So I regulate the insurance companies. And so an insurance company that sells annuity products, they have to get our approval for whatever those policy forms are, and they have to follow New York's consumer protections. To the extent there's a registered, financial advisor, broker-dealers that are selling annuity products, and certainly when it comes to qualified plans, you have SEC. You may also have the Department of Labor with respect to the sale of them in qualified plans. But the state-based system of insurance, in terms of the companies that are issuing those policies, remains. So it's more on the seller and the producer of those policies that would have SEC. And I think where you see some of this overlap is in the DOL fiduciary rule.
Yay, you brought it up. I didn't have to mention the F word. I'm so excited.
No, so the fiduciary rule the Department of Labor under the Obama administration put out is very important protections to consumers that just says that your investment advisor is a fiduciary and must act in the best interest of the consumer. That should not be a controversial proposition. We put out a few months ago a rule in New York, a proposed regulation that is a suitability regulation as well as a best interest standard for both annuities and life insurance. So we added the life insurance on that because the same principles apply. When you're selling somebody life insurance, the producer should act in the best interest of the consumer, and their compensation should not be part of the equation as to which product they propose.
Okay, when you say we are doing this, tell me what that means. Do you have to sell this? Does there have to? Can you basically wave your magic regulatory wand, which I see and it's beautiful. It's got sparkles and you have a tiara as well. Do you get to wave your wand, put your tiara on, and boom, there's a rule? Or does this have to go through some sort of New York State horrible political process?
It has to go through a New York State process, which is called SAPA, the State Administrative Procedures Act. I propose the regulation. There's a comment period of 60 days. We receive comments, and then I can go out with a final regulation after those comments. And the comment period is important. Actually, while we think that we get things right, we certainly don't think that our first draft is necessarily perfect, and that's why the comment period is important. We hear from the industry, we hear from the consumer groups, we hear from anybody else depending upon what the subject matter is, and then we'll go out with our final say. So in that sense, it's not part of a political process, but it's certainly part of a regulatory process. And frankly, the federal government, I wish they would follow that process too, because they tend to sort of do things by fiat without taking into consideration comments.
Okay, so let's stay on fiduciary for a second.
Sure.
Because I love this. So DOL comes out, here's the rule, you have to put the best interest, and then the insurance lobby went to work. I mean, in a huge way. But also under the previous administration. So we know that there was just zillions of dollars spent.
Totally.
Okay. And what they say is, we want to carve out. And from my understanding, so, I'm a certified financial planner. I do a lot of work with the CFP board. My understanding of a lot of people who were involved in this is that the insurance industry was among the biggest critics and battlers of the rule. So if fiduciary's frozen at the DOL right now, and could you, I'm not saying you will, but could you basically say, I am putting into effect a fiduciary standard that's not based on suitability. Like, it is it. This is it. Everyone is in. You have to put a sheet in paper in front of, hey, Maria, you want to buy this annuity? Here's the 3 choice. This is why it costs more for you. Here's what your options are. Customers may still choose to do it, but it would be a strict fiduciary standard. Could a state do that?
So I can do what I have done, which is a regulation that requires suitability, which means the product has to be suitable to that particular
that's
customer.
Easy. That's
right?
all those
And
mooks
we've
know
already
that.
had that
Right.
for annuities, but we're expanding it to life insurance and adding the best interest standard. And the key about the best interest standard is the compensation point, that the compensation cannot be taken into account in terms of the recommendation. So yes, I can do it. Fiduciary as a standard is a little bit more complicated if you're thinking about that word as defined by law.
Mm-hmm.
But I can do best interest standard, and as the regulator require it, it doesn't create the private cause of action for the consumer. But as the regulator, if there's if they're not acting in the best interests, I can certainly go after the company and I can get restitution for the consumer, but it doesn't create that. So that's a little bit of a
I got you. No,
little
that's
bit
good.
legal in that distinction for that. So, but I do what I can.
Right.
And I think this is what we're doing that we can do.
We'll get back to our interview with Maria Vullo in just a minute. Hey, did you know that we have a sister show? It's a podcast. It's called Better Off. You can get it at JillOnMoney.com. You can also subscribe at Apple, Stitcher, Google Play, or anywhere else you find your favorite podcast. Go subscribe. Go check it out. All right, we'll be back with our interview with Maria Vullo in just a second. It's Jill on Money. Right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back with Jill on Money. And, we love dropping an F word here every now and again. Not that one, you dirty people, you. Come on. We're talking about fiduciary, the F word. And we have a great person to talk about the F word because there's so many different pieces of this. Today, we are talking to Maria Vullo. She is the superintendent of the New York State Department of Financial Services. And this is a great opportunity to learn how the states are trying to tackle the word and the application of fiduciary, which financial folks have to act in your best interest, have to put you first. So let's get back to our interview with Maria Vullo. You're a lawyer and you got a big insurance company as your client. And they're like, oh, my God, there are going to be a ton of lawsuits. And listen, I was in the client business. Frivolous lawsuits occur all the time. And you know that too, right? And so we want to balance between protecting consumers but not letting the Yahoo plaintiffs bar go nuts, right? So when you are talking to these people, they talk so much about the litigation risk. What I don't understand is, don't they have risk anyway when people sell crappy stuff?
Well, they do, but if we're imposing a certain standard of best interest, might that create another level? But I don't know how you fight against. You have to act in the best interest of your customer,
right?
And if you do act in the best interest of the customer, and you recommend a product that is suitable for that customer, and your compensation is not part of the choice as to which product you recommend, you shouldn't be sued. And you wouldn't be sued. Are there frivolous lawsuits? They're frivolous lawsuits no matter what. That argument doesn't move me because people will sue. That's just the name of the game, but that's not, I don't think, something that should cause someone in my position to say, oh, that means I'm not going to proceed with what is a very good regulation with a standard that they should follow.
Would it be better to have even a watered-down fiduciary standard from the SEC rather than from DOL?
From DOL or DFS?
Or DFS, either one.
I mean,
In other words, would you rather have it at the national level?
Well, it depends on the applicability of it, right? So the DOL or the SEC don't govern every sale of an insurance product. They only, DOL is only qualified plans. The SEC, similarly, has to be in some kind of an issuance of something that's connected to a security. And so, or the investment advisors and that. Life insurance products are sold by people all the time that don't have the certified, requirements that would be for qualified plans or for SEC registered
So they would fall
securities.
they'd fall through the cracks anyway.
Of course, and that's why now annuities are but even the DOL rule was only annuities in qualified plans. So that doesn't apply to all. The regular person out here is buying an annuity or a life insurance product from a broker or from an agent of an insurance company that would not be covered by either of those rules. And that's where the states really come in, because we cover it all. And the debate that we're going through right now is, why, DFS, are you covering life insurance? Because we know that qualified plans have annuities and some life insurance, but life insurance is a much bigger market that is not covered by the DOL rule.
How do you, I guess that you're like not invited to Hartford a lot because they don't like you, because the insurance companies don't like you, or do you get big pushback?
I mean, from time to time, obviously they express their point of view. And I listen to their point of view and I express mine. I think on this one, we actually have some companies, like the mutual companies, that are certainly, more positive about applying this to life insurance compared to some of the for-profit or the, out-of-state insurers. But I think, they recognize that we will engage in a dialogue, but first principles are you should act in the best interest of your consumer. And
right.
You want to. And I don't see how they fight that, and so I think we'll come up with something that addresses some concerns but still has that main thing. And some of the current concerns are logistical, and you mentioned documents and all of that. So what exactly does the producer have to give the consumer? And how big a choice does the producer have to consider in choosing the product to recommend?
I was talking
there's a lot of issues.
So I was talking to a securities lawyer, a Wall Street securities lawyer, who was just chewing my ear off about, like, you don't understand, this is going to add millions of dollars to the operating costs. And I'm like, I don't understand that Amazon can get like a big, huge, like 12 rolls of Bounty to my apartment in 28 hours. And you guys can't figure out how to create like a seamless process. And it does seem like there is a litigation fear, but it's also a process fear.
Yes.
And how do we oversee that? They don't want to have to put a system in place that's for this, 80,000 CFPs across the country. They don't want to have to do that. We got millions of brokers, blah, blah, blah. I am just always mystified that why is it feels like it shouldn't be so hard, but I guess it is.
Well, look, I mean, I always think there's a difference between the outburst that you're referencing in them saying these things to be able to push back on some reform, as opposed to, is it really as bad as they say it is? And I don't believe it's as bad as they say it is. I mean, they have to onboard all those people. They have to put whatever the financial records to be able to pay them their commissions or what have you. That's all onboarded. I hope electronically. I hope in a seamless way. They certainly want to do that. I don't see putting all of this, figuring out what exactly they have to do. So when they do their analysis of suitability and best interest, what products should they be considering, and what documentation. The documentation requirement, by the way, protects the producer.
Right. You're getting someone to sign off.
Exactly. So they are protected by it. They're saying, these are the products that I considered. This is what I recommended to the consumer. These were the factors that caused me to do it. That protects them. So this fear of lawsuits, we're actually protecting them by creating the process. And I don't see that process as being that difficult. It might take some time because they need to work it through, because they have producers and agents, depending on the company. It may be very different how they're structured. And we'll work with them on the timing of it and making sure that we're clear on what we're requiring. And that's really, I think, the give and take that's going on right now.
Okay, when we return, we will conclude our interview with Maria Vullo. But while we're on the break, let's do this. Why don't you just hop on to JillOnMoney.com and check out some of the cool stuff that we write and broadcast. It's on TV. Check it out. JillOnMoney.com. We'll be right back.
Have a finance question? There are many ways to reach the show. You can call anytime at 855-411-JILL, send an email to askjill@jillonmoney.com, or tweet a question on Twitter using the handle @JillOnMoney. Just use the hashtag AskJill.
You are back with Jill on Money, and we are concluding our interview with the Superintendent of the New York State Department of Financial Services, or DFS. Her name is Maria Vullo. And what's so interesting is that all of a sudden a esoteric, strange part of the regulatory world has entered the political realm. You may have heard a lot about these stories around who's connected to money laundering for Russians and now Saudi Arabians and who knows, and Qataris. Well, this is a segment of the regulatory regime called AML, anti-money laundering. And it's so fascinating. It used to be, sort of a mobster kind of activity, and now it's moved into lots of other things, changed pretty dramatically since the 9/11 attack. So let's conclude our interview with Maria Vullo with a little AML boot camp. Let's talk about anti-money laundering, one of my favorite topics. Can you talk about whether or not DFS would get involved with examining claims of money laundering among real estate companies, small banks, hucksters? Talk about how you find that and what you can do.
Okay, so I cannot speak on any particular investigation.
Oh, no, of course not.
And so, but as a general proposition, not specific to any party or a company.
Right. Mark and I have a business, and we're bringing imported pasta in from Sicily, and beautiful place.
Yes.
And we are churning through and getting lots of we got banks, lots of different bank accounts, and Mark's college friend Svetlana Uskakova is our money person. She's backing us. She's not a U.S. citizen. And there's a lot of money coming in and out. And, all of a sudden, from our pasta company, we're buying, huge penthouses in fancy buildings all over New York. Then this guy, Rich, gives a tip, calls up your office and says, I think there's some funny business going on. What happens from that moment?
So as the regulator of New York State Chartered Banks, which includes over 100 branches of foreign banks, since so many of these foreign banks have branches in New York, we give them the license to operate there, as well as the New York State Chartered Banks. To the extent we learn of any tip or any information where there could be the possibility of money laundering or the possibility of access to capital by a politically exposed person, or anything that would raise an alarm or should raise an alarm by that financial institution, then any of our institutions, we can ask them questions and they have to produce the information to us. Money laundering is a critical area that my agency DFS is focused on and has been since its founding. In fact, one of the regulations I did was a transaction monitoring regulation, and we've done many consent orders with institutions who have not appropriately addressed money laundering concerns. Mm-hmm. It's a real concern. Real estate is always a place that one looks, because if you're someone in Russia with cash, you want to get that cash out of Russia or in Ukraine or some of these other countries. That's what they want to do, because it's worth a lot more if you get it out.
You're laundering it to clean it out. Right.
Exactly. You're getting out of there. And real estate, very large condominium purchases. Real estate is a huge place for money laundering, because then they park the cash there. And if they then subsequently go and get some financing to pay back that money to the person who helped them do that, there's money laundering. And of course, money laundering is used, for the drug trade and lots of other terrorist financing and other things. So we do look at that. I don't regulate the real estate, but it's the financial institutions, the banks that I do.
In closing, This is great because it's like regulatory boot camp, which I love.
Yes, great.
So you made this. I just want to ask a personal question for you, is that you made this decision after we get so many people who call the show and they're really contemplating sort of a second career, a third career. How did you come to the determination that you want, besides being, asked, which is wonderful? You live a really comfortable life. You're sort of on the train. You got a corporate lifestyle. What factors did you consider before you decided, I'm jumping off the corporate train and going into public sector work?
I think the question for me, and it continues to be the question every day, is can I make a difference in people's lives? While you can do work in the private sector, and I'm pro private sector obviously as well, I think public service is the place where you can make a difference in people's lives. And if you're committed to doing that, because it's not just touching one person, you can touch many people with your action. And it's the motto that I live by at the office too, when I ask people, what can we do to help? And I say ordinary, real people. You can have policies, you can have all this stuff. How are you actually affecting people and making their world better? Public service is not for people who want to destroy government. It's for people who believe in government and believe in government working for the good of people. And so that's the reason I did it and continue to do it.
Thanks so much to Maria Vullo. She is the superintendent of the New York State Department of Financial Services. It really is so interesting to hear how somebody who moved into a role back in 2016, how that role really did change pretty dramatically over the course of the last year or so. Whether or not she stays in that office has been up for some speculation. We'll keep an eye on her, but she was a great interview, very informative and very interesting. So thank you to Maria Vullo. And if you've got a financial question, you want to learn more about any of this, just shoot us an email. Ask Jill at jillonmoney.com. We'll be back with one of your final questions for the last itty-bitty segment of the show. Stand by. We'll be right back. You're back with Jill on Money. This is the program that takes the mystery out of your financial life. I am Jill Schlesinger. We are concluding the show, maybe with a little nod to the fact that everyone is looking forward to summer vacations. I know we are here. But you never know when we go on vacation, which is fabulous. You can try to guess. Hint, who on earth would work 4th of July week when 4th of July is literally in the middle of the week? There's no way I'm working that week. Okay, Scott is also not interested in working for a portion of the summer, but he's writing about a trip that he's taking next summer. I have a family of 4, and we're looking to take a trip to Italy next summer. The trip is estimated to cost $15,000. It's actually not that bad for a family of 4. Venice, Rome, and the Amalfi Coast. I see some advisors, robo-advisors, have short-term goal account options. Would you recommend shifting to something like this for $15,000 so it can grow as much as possible in a year's time? Well, let me ask you something, Scott. How would you feel if your $15,000 was worth $14,000? Maybe having a short-term account sounds like a great idea because maybe your 15 could be $17,000. But if there's any risk at all associated with this account, I would avoid it. If you are saying to me you just want to put the money in a 1-year CD, sure, get a little bit more than your average money market, get more than your checking or savings. If there is one shred of extra risk involved in this account, absolutely not. How would you feel about that? You need $15,000. You're going to need it exactly in 12 months. And, 11 months from now, all of a sudden, maybe it's not going to be a huge hit, but your 15 is worth 13. How would you feel about that? I would feel terrible. Ergo, ixnay on the separate account. Okay? Mark's laughing. Have fun. Start tasting limoncello now. It's a very acquired taste. Not my favorite, but Mark might make some in his basement someday. Okay, thank you so much for listening. Thanks to Maria Vullo for joining us as our guest. If you've got any questions, you want to catch up with us, you can always send an email, askjill@jillonmoney.com. And, of course, all the old shows up at jillonmoney.com, our website. Thank you so much for listening, and we'll chat with you next week. See ya.